thank you and your organization, both organization, Equalify and Internet Alternative Investment Fund Association, for taking the lead for last 9 years to create an ecosystem for alternative investment fund in India, and connecting the dot on both the side, investor, product creator, manufacturer, and also convey the voice to the regulator or the market infrastructure creator to really contribute to the what is the bond market or any alternate investment market environment in India. So yes, it is typical post-lunch session, but definitely we'll try to break the myth and try to create and bring exciting information probably you are craving for in this space, and break the myth, a lot of myth probably in bond credits in India. So to start with, let me say the quick format. Initially, we'll look back to the what happened in credit space in last 10 years, a lot of events on maybe 2018 crisis, IL&FS crisis, how the product or the ecosystem has changed. Then we will get deeper into the solutions. Two gentlemen on the panel today, they themselves and along with their organization has been able to break through and create a wonderful product out of this, identified the opportunity. Then the last 5 minutes, maybe we can address if we have not been able to address your question or maybe some of the areas you are keen to understand on a Q&A session. So to start with, let us quickly introduce to the panel. Let me start with me quickly. So I represent FinIQ Consulting. It's a financial technology company. They're into existence for the last 2 decades, largely serve to the top 50 global banks, globally present in 14 countries. In India, we are very new to Indian market. Globally, we are the largest platform or infrastructure solutions, technology solutions provider to structured product. And today, as we speak, we are the largest in that particular space. Apart from that, we cover all 3 asset class like equity, debt, or any kind of complex derivative, creating platform solutions infrastructure. Now I would request our eminent panelists, Ravi and Arijit, to quickly introduce, then we'll get into the topic. Over.
Sure. So Arijit, you want to go first or?
Sure, I can quickly introduce myself. So I work with Trifecta Capital. It's India's first and leading venture debt fund. So venture debt is a product which essentially involves lending to startups. So these are emerging new economy businesses, so slightly different from a lot of the credit activity which you would have seen in the past, which revolved around SME or mid-corporate lending. These are companies which usually have a large tech component in them and not too many physical assets. So it requires a very different approach to underwriting. We've been in business for the last 7 years. We are currently in the middle of our 3rd venture debt fund. On the equity side, we have also launched a Leaders Fund, which doubles down in some select opportunities, especially in late stage growth equity. So we are trying to essentially figure out financing kind of solutions or places or pain points where new economy companies feel that there is a gap. And we've tried to address that gap, primarily led by credit and now also with some equity. We have disbursed a total of, I think, around 2,700 crores, so around 400 million of credit in the last 6-7 years. The market has grown substantially, and we expect to be deploying around 1,200 to 1,500 crores this year as well. And on the equity side, we've deployed around 800 odd crores in the last 7 months that we've been in business. So that's a quick summary. The kind of companies that we work with, just to give everyone a flavor, companies like Big Basket, like Urban Company, Rivigo, Inframarket, Vedantu, LiveSpace. So large category leading companies which have built substantial businesses in the new economy. Those are our partners of choice. And we invest all the way from a Series A business all the way till late stages of Series D or E. So yeah, that's what we do, and happy to take part in this discussion.
Yes, very interesting, Arijit. I think everybody here on the audience are very well aware of the buzz in the private equity. I think private debt is something you would be able to highlight. Excellent. Ravi?
Sure. Thanks, Alok. So I lead Northern Arc Investments. Northern Arc Investments is part of the Northern Arc Group, which is a more than a decade-old group headquartered out of Chennai, with comprised an NBFC, and now the fund management arm is called as Northern Arc Investments. We have been here for the last 7-8 years, and we run about 9 funds, mainly in fixed income, spanning everything from, I would like to say that we start where mutual funds stop, and anywhere from 8.5-9% to 16% is our space, where we have primarily lent to operating companies, right? So OpCo funding within NBFCs as well as mid-market and manufacturing companies. So that's the overall size. Overall, can say introduction. We manage about over $500 million of commitments and have deployed as much. And I think we've returned about 1,500 crores since inception out of that. So all performing space, high yield to mid yield at different junctures between balancing liquidity, market risk, and high yield. So that's the overall journey. Happy to have more discussion as to how we managed to ride the credit wave for the last 7-8 years, catering to both the diverse institutional as well as domestic HNI investors while delivering on credit. I know credit has been a bad name, and some of it was raised. Alok, you mentioned part of it. Aditya mentioned it as well in terms of India catching up. So looking forward to this discussion.
Yes, wonderful, wonderful. In fact, Ravi, since Northern Arc being the pioneer in that particular space and last almost more than a decade, your organization has been trying to create that ecosystem, connecting that dot. So probably we will try to create that thread for the audience today, taking a little back what has happened in the that credit space overall as a country. So as we all know that corporate bond market, so for today's session, we'll focus more on corporate side of credit and how we can create an investment ecosystem out of that. So as we all agree, corporate market has not been able to develop or has not been become that large what it is supposed to be today compared to any other developed or emerging market. So in terms of the size, still it is 18% of the GDP compared to any other developed market. If you look at US, 120%, or even if a small country like Malaysia, also 44%. That gives, on the contrary, India is a economy of savers, and we hardly able to draw that domestic saving on toward the corporate. On the contrary, bank credit also has not picked up as it's supposed to pick up toward the broader large corporate space. That leads to Indian corporates are struggling to raise money both on the bank side as well as from the capital market side. So although a lot of government initiative, different recommendations from the high level committee has been in the past, but it has not been able to create that ripple effect what is desired. Yes, probably we'll highlight on those. Couple of them would be due to GSEC market. It has crowding out of this corporate debt from this entire debt market. Still, they have lion's share, more than 90% or maybe 80 to 90% are GSEC when you refer to Indian debt market. And also persistent inflation, maybe which may force this corporate to pay high interest for that against their borrowing. Maybe most of the corporate are still comfortable with private placement to know their counterparty and commit to counterparty on a private placement basis rather than a public platform. maybe there is huge information asymmetry. We don't have enough information barring top few AAA rated company in India. And also contrary to that, even when 2018 crisis has happened, some of the AAA rated companies also defaulted. That has also impacted negatively. Since 2013, Indian debt market has started gradually picking up, but post 2018, even if AA rated or A rated papers still struggling hard to find a place among the portfolio of even with large institutional investors like insurance, pension fund. Only AA and AA plus and above companies are able to place their debt toward the institutions, and which is a major challenge today. On the contrary, post this pandemic or post this government initiative in terms of the liquidity infusion or government initiative, that retail deposit, institutional money, FPI money has been flown to equity market as compared to debt. So we'll try to hear from both of you how we can create an ecosystem which can help to channelize that domestic and institutional money toward the corporate, and how we can mitigate risk, so that the repeat of 2018 crisis may not happen, or maybe the process which will help to prevent that process to repeat. So let me hear from Ravi or Arijit. Anyone would like to take the lead?
Sure, Alok. I think you mentioned a lot of points and very pertinent ones at that, in terms of the size and scale of the market and compared to the others. There is no lack of capital. Like you said, India is a country of savers, right? So it's more about market mechanisms and trying to understand why, say, the market has not developed enough to serve probably the needs of capital across, say, a lot of the corporates, whether it is in the SME space or otherwise. So the market size is huge. India is a nation of informal and small enterprises, and hence access to capital is a huge need out of this. Now, just a small point of view difference with what you said. When you compare Indian debt market with the other markets, like you mentioned, right, as a percent of GDP, India ranks lower, like you correctly pointed out. But the fact is that it has grown. If you see over the last 15-20 years, the corporate bond market today is close to 35 lakh crores. Right? And a large part of this has grown because of the regulators' push in terms of mandating some of the borrowings away from, say, the loan market, which is a privately held, bilaterally negotiated bank market. And that's how typically a financial economy also develops. Initially, it is banks and bilateral deals, and then it slowly moves towards higher levels of governance with capital market instruments. So in terms of outstanding stock, there is a lot of corporate stock which is available. Corporate bonds are 30 plus lakh crores. The GSEC market is obviously the most liquid market here, but that is also 40-50 lakh crores of outstanding stock. So size of market is increasing, while maybe still suboptimal as compared to other markets, but there is enough to channel the need or service the needs of domestic borrowers. Now, domestic borrowers are servicing or are financing the government deficit or the government bonds, but largely via banks, because banks have SLR requirements where they have to save a lot of this. So one is the availability of capital, which is there. Second is the availability of deployment opportunities with more participation of corporate bonds. This is increasing. So opportunities are there. I think even in the BBB space, A space, AA space, we will find that corporates are now set up and are issuing capital market bonds. And there is a public bidding system once it crosses a certain threshold. So it's more about the mechanism on how you connect the two, which earlier has been largely via banks. Right? Now, for lack of any other vehicle, most of this development happened in the mutual fund space, where credit mutual funds were launched starting 2007-8, post out of the crisis, was the birth of credit mutual funds, and this grew. But over the last decade, and especially after the few events that have happened that you mentioned, one thing that came out very clearly was that while credit has risk in terms of credit risk, there are two other accompanying risks which are not well thought of. That is market risk and liquidity risk. And unless you structure the vehicle properly, those two risks can derail the investment objective of your portfolio. Now, what is the reason that you like an FD or everybody likes an FD? Because it's a certain point in time, you know what you're going to get. So there is no market risk. There is really no liquidity risk, because with a penalty, you can get your money back at any time. There is no question that you cannot get your money back, even if you want to redeem before maturity. Those kind of features are not really available, or if they are available, then they have certain trade-offs, right? So outstanding stock of corporate bonds is there. Market mechanism of liquidity is not there in corporate bonds because there aren't enough participants, unlike the equity market. So it's a little bit about choosing the right vehicle so that you can address, say, the liquidity as well as the marketplace aspects of credit. But otherwise, as we have demonstrated over the last few funds and few years, the needs of investors, whether it is from an 8-9% to a 16%, can be very well met with a diversified portfolio, as long as you counter for these two other risks besides credit. It's not a question of underwriting, it's mainly a question of vehicle. And with the recent events in the mutual fund sector, I think alternates as a proper vehicle to structure some of this risk, to connect the savers with the outstanding corporate bond market and help their growth, is increasing significantly. As with every year, you see the volumes on the corporate bond market is increasing. So that market is definitely improving, and that is with OpCo funding. And there are many other opportunities, such as what Arijit will explain on the new age economy, and with other special situations such as HoldCo funding, etc., that we can also discuss later on. But the summary is that the market is definitely improving. The size is there. The mechanism needs a little more work with more participants. And as long as you can have proper structures with governance addressing both market as well as liquidity risk, this segment is actually outperforming quite significantly.
Excellent, excellent. So I'll take a view from Arijit, and I'll again come back to Ravi with your reference point, like liquidity, how a market ecosystem can add the liquidity. Let me hear first from Arijit. What is your view, your organization, how you contribute to this development of this debt market or credit market in India?
Sure. So, we operate in private credit where the bonds that we subscribe to are usually, they're not traded, though they are tradable. But, like Ravi said, I don't think there are enough market participants to really ensure that there is liquidity and, these bonds can be disseminated to a wider market. So the approach that we've taken is of private credit, where we tap into some of the wealth or the high net worth individuals of this country. We tap into some of the institutional capital, whether it's coming from banks or insurance companies. And the approach that we've taken is, bringing some of these institutions, giving them a flavor of credit in niches which they were not investing in earlier, does improve their appetite as well. And then further going forward, they might also consider kind of direct participation. But for now, the role of a manager to facilitate that is quite critical, because there are several niches which banks, NBFCs have still not targeted, and especially in the last few years, there have been a few liquidity crises where the banks have had their own set of challenges around managing of the NPAs which had piled up over a period of time. So given that there were a lot of extraneous kind of considerations, in banks, when they looked at investing on the large corporate side, the mid corporate side, we see quite a few gaps that emerged, which were not being targeted. And that's our role that we see. How can we fill some of those gaps, and how can we bring in pools of capital which are a little wary or did not know how to actually identify opportunities and bring those opportunities to them through a fund structure, through an AIF structure. And the AIF structure has worked quite well in the last few years. We've seen a lot of participants move to this structure. because it's a way to bring in some of the larger pools of larger, I would say, individual pools of capital. The retail side, I think Ravi was absolutely spot on that figuring out liquidity risk and market risk. If we do not solve for that, bringing in a retail investor into the bond markets will be difficult. And while debt mutual funds have made some progress, I think there's a lot to be done there.
Correct. I completely agree. In fact, both of you and your organization is trying to create first step of that to create the bringing loan originator to the middle layer, maybe in the form of a fund or in the form of a connecting with the LPs who have the appetite to stay invested till the maturity. So the first step is holding all this paper till the maturity. And once this market have enough breadth or depth, maybe that is the time you may create a secondary market or the liquidity, what Ravi correctly said. And with that, maybe the third step, we can see the retail participation into that market may emerge. So any direction both of you would like to say, or any methodology in terms of market architecture you would like to, for example, both of you have created credit AIF. Do you provide internal liquidity or do you provide third-party liquidity provider to absorb maybe interim or for that you require a pricing of your instrument during the journey? So any outlook on that?
Sure, Alok. So it's a very interesting point on liquidity. And liquidity has to be measured at two levels. One is you cannot create something which is not, or you cannot offer something which is not available in the market. Right? If today an investor wants to exit their position in, say, an A-rated or even a AA rated paper at the price at which they bought, no questions asked immediately, such kind of liquidity is just not available in the market today. There is no vibrant junk bond market or high yield credit market in India as compared to, say, developed markets such as America, right? The other way to circumvent this is to make the vehicle liquid. So something like an ETF. Right? When you invest in an ETF, you're not really transacting in the underlying securities. You're transacting in the value of the vehicle itself. Right? So you unitize the product, and that's where liquidity does not interfere with the underlying portfolio, which today is not liquid. Right? So this is one aspect that we have done some market making in for our own products. So an investor who is looking to exit, right, doesn't necessarily disturb the underlying securities, because those securities we cannot go out and sell in the market. Right? Arijit mentioned that there is no liquidity in some of the papers that they do, and this is prevalent across all kinds of credit. It doesn't necessarily need to be in venture debt. Even a AA paper by mutual funds were not really liquid when the time came. Right? So if you unitize the AIF or the vehicle and make sure that the ability to assign a net asset value is correct, it's not like the mark to model kind of valuation which used to happen in, say, all the CDO squared structures that led to the great financial crisis, the global financial crisis. But if you can do a high level of transparency, disclosure, and valuation of each underlying security, especially in operating companies today, you can unitize and have a market maker in the vehicle itself. And BSE and NSE both have listing guidelines for AIFs. I think it's still not progressed to that level, but as more and more of this is available, I believe that liquidity will be more at the structure level rather than at the instrument level. Right? Because fundamentally, if I give you an example saying that I have a 3-year AIF product, I have a 5-year AIF product, which, say, has invested in 10 companies or 20 companies at either 10% each or 5% each. Now, as time progresses, some investors would have a 3 or a 5-year holding period in line with what the product does. But at the end of the second year, there is definitely far more appetite for a 1-year residual maturity AIF or a paper as compared to a 3-year one. Right? It fits into the bucket that a lot more would be comfortable with that kind of risk. And hence, you have opportunities for both an early exit as well as possibly a capital gain, because now the residual time to maturity is lower. So I think some of the market architecture and ecosystem in terms of incentivizing additional players will lead to more market making in the structure itself, which solves the problem of liquidity. Waiting for development of the bond market, which is probably a yearly seminar or an event saying that we need more liquidity in the market, and that has happened since the last 20 years and not really yielded that much results. Waiting around for that is probably not going to solve the problem, according to me.
I agree. Maybe annual event may not solve the problem. Maybe it should be more repetitive and more participative on a regular basis to find out the right solutions. Let me hear from Arijit.
I think on the private side, even in private equity, those positions are not really tradable, right? Until a company lists. So there is always a gap in terms of arranging liquidity on the private side. And that risk, I think, is priced into the kind of expectations that investors come in with in terms of yield, in terms of outcomes. So I mean, while all AIFs have unitized to some extent, I don't think there has been a lot of activity around actual trading of those units. That's still a work in progress. And on the private side, what we've essentially tried to do is first, bring in some of these pools of capital, because until people experience the underlying paper and see the kind of track record, it becomes very difficult for large institutions to set up teams to, kind of essentially track this and participate in secondary markets. So our approach has always been to, kind of facilitate some of the primary activity. The secondary activity, there are a few initiatives that we are thinking of, but those are yet to play out. So let's see.
Correct. I agree. Maybe it is required to draw or create that market pool relatively larger than look at the secondary market. Only challenge is that probably in this journey, maybe initially you are attracting institutional money, large, long tenure investor. Maybe that's the same with Ravi also. But what we are intent to provide to create a retail participation or individual participation in a bond market, maybe they'll have to wait for a little longer period, until unless they have that kind of appetite to invest for a long tenure. Normally, this kind of AIFs are 5 years, 7 year plus AIF. So,
and also, I think that there is a cutoff in terms of ticket size. So that alone sets, brings in certain categories of investors, which might not be suitable for retail right now.
Correct. So now, contrary to the right strategy, maybe recently we have been seeing retail bond market, and a lot of market participants has created a retail platform to offer bonds to the retail investor in a smaller denomination through a retail platform. Everything has a pros and cons into this. Maybe it has some merits if investor hold it till the maturity. Again, the same challenges. If somebody is coming in without an appetite to hold it till the maturity, they'll have to face the same problem: interest rate risk, or maybe the interim risk till that maturity. How do you look at, and how you feel that could be the one approach to create an appetite, create an ecosystem in the market, and which will complement to this kind of pool investment into credit eventually to come into the market for a larger investor faster?
So retail investors in high risk bonds, that's something that I'm not really that much in favor of. So I think it leaves quite the option of, leaves the open door to misselling or advice. I think for retail investors, the way a transaction is done should be by looking what is the cost if the decisioning goes wrong. Now, if you buy a stock in the Nifty 50, even if your decision goes wrong, you hopefully won't have much to pay for it. Same with if you buy a AAA or a GSEC, even if you did not do much research, but you went and bought into it, you hopefully don't need to think that you're going to lose your shirt in that. But when you start, if you invest in a small cap or a penny stock or some of these pump and dump schemes or tips, etc. Same in the equity market. Say, at least in the equity market, you have unlimited upsides. In the debt market, investing without having done that kind of research. And the problem, which Alok, you yourself mentioned, that the access to information with respect to corporate information in unlisted companies is not there for you to take a qualified decision. So one is to have the skill set to be able to assess the risk, the true risk return of a higher yielding bond. And second is to have that access to information. Right? I give this example about how during COVID, everybody started baking. Right? Either you have the skill set to bake or you have the time to do it. Assuming that you have the time also doesn't mean that you're a baker. So even if you have the ability to understand financial information, you need access to ingredients, which is the information, and the ability to spend that time and do it. But with a full-time job, this doesn't really work, right? If you're working somewhere else. So retail investors in bonds, it's better to come with advice. The cost of professional advice, and Arijit also mentioned that the cost of advice is not much. Markets are very competitive now in terms of managed products. We probably need to just find a better structure where retail investors can participate in a pooled issuance rather than do direct investing in bonds, which neither offer you unlimited upside, but probably offer you the risk of your capital going to zero. So I think advised capital is much better. SEBI rightly has kept the ticket size high for alternate investment funds because these do take higher risk. But I'm a firm believer in diversification in credit. If you have 100 rupees as a pooled capital and you are investing 2 rupees in every security, then with a 50 security portfolio, yielding say 7 or 8% a year, even at the lower end, that means that even if 4 securities go bad in a year, you still get your capital back. So a pooled structure with diversification covers for almost everything as compared to retail direct investing in bonds. And probably the platform itself will come under the scrutiny of SEBI because it's very hard to prove mis-selling in that case. So that's my view on it.
Okay. So clear guideline from Ravi is that pool is always advisable when you are venturing into any high yield debt. Quick comment from Arijit. Yes.
To add to that, even in developed markets, if you see, direct retail participation in bonds is not what moves the needle in bond markets. There are a variety of institutions, and in fact, the markets are so developed that almost at every 2% kind of rate increment, there is an entirely different market, right? So you have a market for the 10 to 12% debt, the 12 to 14% debt, and obviously these are Indian numbers, but corresponding to those in those markets. So I don't think retail pools of capital are necessarily the answer to creating a functioning bond market. We need more institutions. We need more, I would say, so-called expert, pools of capital who can understand this better and participate. And for that, awareness has to be built. So, awareness as to what are the different kinds of products available, the connection of bringing them into certain niches, showing them the track record of certain products. We found that that is very meaningful, and it leads to LPs and it leads to the capital providers increasing their commitments to these markets over a period of time. And as you create an asset class, in private credit is a growing asset class across the world. In India, it's still early days, but as you create it, I think you will see a lot more institutions, similarly segmenting the market, creating their own niches around specific yield and return profiles.
I agree, Arijit and Ravi, both of you. But the challenge is that now we are talking about channelizing the saving of the investors, mid-size investor who doesn't want to invest 1 CR into this kind of opportunity, but still they are comfortable with 5 lakh, 10 lakh, 20 lakh, maybe lesser than 1 crore. So that space is still vacuum. So maybe that is the space these platforms are trying to capture and trying to offer some of the rated paper, AA rated paper.
So not on the AIF side, but what we are seeing, quite a few interesting startups. And again, startups are doing a lot of interesting things in this space. But we are seeing folks go after retail pools of capital, like you just mentioned, anywhere from 1 lakh to 20 lakh kind of pools, and offering products such as invoice discounting, such as leasing, directly to retail investors. Now, the question is, again, as Ravi had pointed out, is there any mis-selling happening? Are the risks being communicated well? But we are definitely seeing a lot of startup activity, in credit products for retail investors as well.
Correct. So
actually, Alok, just wanted to add to that. So there is a second, it's not an option, it's already live, that there is an intermediation that is happening by way of intermediaries which are pooling the capital, right? And these are, so something like insurance. Insurance pools bite-sized premiums from investors, which is basically savings, right? Because ULIPs are sold as savings products. Similarly, mutual funds as well. Insurance is allowed to invest in AIS, right? So the insurance company has the resources to take a proper risk return assessment and decide where to channel some of these, right? So in the end, you are channeling the domestic savings, but there is one more layer in the middle. But that layer is the one which is exercising discretion. And that's the layer which is taking into account the responsibility that they have, the fiduciary responsibility to its retail investors. A similar thing is there in mutual funds, but mutual funds are not allowed to invest in AIFs because I think it was not envisaged in terms of having a third party do the investment advice for them. But I think the regulator and everybody is coming around to the view that mutual funds are catering to a wide variety of products and hence wide variety of population, and hence have more vanilla products, say listed equity or AAA or AA kind of bonds or G-Secs. And for that additional kicker or that exotic flavor, it is okay to have some allocation into an AIF. So I think if you have these intermediation channels which are already available, just by tweaking the regulations a little bit, which allowing for more participation into some of these AIFs, will help to channel a lot of these financial savings into these high-yielding alternate asset class.
Correct. So we are almost nearing to the session. Just to quickly sum up the key point, takeaway point from the sessions from our eminent speaker today. So right approach to develop the Indian bond market, or rather corporate credit market, is to bring in larger participation from different institutional investors who have appetite for a long dated, and channelizing their investment or their portfolio through the form of insurance product or maybe mutual fund product to the retail investors. This saves the both the purpose, that saves the liquidity risk, because all these investors has the appetite to hold it till the maturity. On the contrary, it saves the investors to diversify their risk and also participate this opportunity of high yield or the extra spread they can enjoy by investing into this instrument. Only the question remain open whether the same kind of small case or small basket investment in debt market may emerge in recent future, or maybe is it good or bad. Or second point of what Ravi suggested, ETF could be one of the solutions which helps to provide some bit of liquidity, or also may force that structurer to disclose more information toward the underlying or the product itself. These are the open point. With this note, with this short span of time, we try to capture all aspects of credit and opportunity ahead. And the players in the market who are trying to create this ecosystem to develop Indian corporate debt market, we are seeing an exciting opportunity going year ahead, or maybe next 5-10 years is very robust. And recent Morgan Stanley report also suggested it is going to double, as the depth of corporate debt market is 35 lakh. Maybe we are looking at to become 70 or 75 lakh by 2025. Recently, government initiatives is always opportunity. Recent today's monetary policy review, RBI has increased this FEI limit from 1.5 lakh crore to 2.5 lakh crore. So that would also help to channelize some of the foreign institutional money to India in corporate debt market, along with the GSEC. So this space remain very exciting. I would look forward to Aditya to arrange this kind of session on a regular basis. I think our audience, all wealth managers, investors, will be keen to look at this space on a continuous basis. With this, thank you so much. Thank you, Ravi and Arijit, to taking out your time from your busy schedule. to be a part of this session where Aditya has taken a lead and actually trying to create an environment ecosystem around this industry. Thank you so much. Thank you for patient hearing. We can quickly take a few questions. I think we are already ahead of time. If Aditya permits.
Yeah, Alok, I think we are definitely exceeded the time. We other session panelists are here. I'll just quickly ask the audience. You have the ask a question tab on your screen. If you have any questions, just please quickly ask. We'll not be able to take more than one or max two. Let me see if we are getting a few.
Till that time, I would like to thank Equalify. Thanks, Aditya, for putting together this forum. This has definitely been appreciate you inviting us to share our views, and look forward to this. I think it's a yearly event, but as frequently as possible.
No, absolutely we should. And now that BKC factor connection is there for all of us. No, and more importantly, I mean, I've been telling that since yesterday in all sessions, and I'm very seriously hoping this is the last virtual thing we are attending now. Enough.
Most definitely, yeah.
Back to meeting people, I think that has its own charm.
Yeah.
I hope there is no question. I think let's close the session. Thank you so much from Aditya and entire team, forum, and to all the audience. Thank you so much.